Well, right now, we're actually advising our clients to stand pat on their equity allocations. And as far as regional exposure, we actually think it's good to continue to have a diversified exposure across the U.S., IFA, and emerging markets. And really the reason why is if you look globally, we're still expecting moderate growth, both in terms of the macro outlook as well as the earnings outlook. And while, as you note, Melissa, there is some slowing in the earnings picture. Overall, our indicators would show that the fundamentals are still looking okay going forward.
You know what's amazing, Jack, is that, you read the stats, 77% of companies have pre-announced so far for the second quarter, and yet we're sitting basically at record highs. I mean, is that sort of a good thing? We sort of worked our way through that concern, and the markets maybe reflecting it already.
It could be. I mean, the fact is, you're right, analysts are expecting a 2.5% earnings decline year over year through the second quarter. But keep in mind that analysts had expected a similar decline in the first quarter, and companies were able to beat and get that earnings growth positive. So I think that investors are looking at that saying, look, one quarter, maybe it's negative, maybe it's flat. But as we start looking out into Q3 and Q4, we start to see earnings growth expectations ramp up.
What do you expect from the Fed, Jack?
Well, it's what I think the Fed should do and what I think the Fed will do are probably two different things. One is I don't think the Fed needs to reduce rates to ease economic tension or to continue to grow the economy. I think the fact is we're on a 2 to 2.5% growth path. We should be able to do that without the help of the Fed. But as Melissa mentioned earlier, buybacks are starting to run dry. And I do think that we do need help from the Fed to keep the stock market going. And if you look back over the last 5 years, earnings per share has doubled the pace of net income, largely because we're reducing the denominator of that equation, shares outstanding.
Lisa, I wanted to ask you about what is gaining in today's session, what is gained in past sessions, and that's the safety trade. Utilities, for instance, are up today. And I'm wondering, if a client came to you and said, I want safety, but I still want to be allocated to stocks with stocks at close to record highs at this point, is it worth paying 20 times current earnings for utilities, which is a premium to the S&P 500, or for some staple stocks, for instance? How do you navigate that?
Well, our favorite sectors actually are more growth-oriented, and really the reason why is we believe in a more moderate growth environment. Ultimately, investors are going to benefit from that extra ounce that they can get with sectors such as technology or consumer discretionary. So what we're really favoring are those industries where, again, some of the top-down changes we're seeing in terms of more movement to cloud computing, demand for robotics, shift to internet shopping, really should benefit some individual companies and names in those areas. And we agree with you as well that with the flight to safety, some of those valuations in the more defensive sectors are less attractive.